everybody. Thank you for coming. Just want to make sure I get it all. So for those of you who don't know me, my name is Porter McConnell, and I run the Take on Wall Street campaign. And I really want to thank you for joining us. I know it is a little on the early side for a DC event. And for folks on the live stream, also want to say thanks for joining us as well. And now comes the less fun part. We are all here today because of an ugly truth. The financial industry, as a share of the overall economy, has more than tripled since World War II. The financial sector, Wall Street, has now found a way to extract maximum profit from every facet of our lives: our housing, our health, our education, and even our water. Last week, we learned from Bloomberg that the 6 biggest banks have gotten a $32 billion windfall from the Trump tax cuts so far. They passed most of that windfall on to themselves and their shareholders. So we basically just gave the big banks a bonus worth about 400,000 teacher salaries. But the current hot mess of the financial system is not in any way inevitable. There are two main reasons we need to chart a very different path, and soon. First, judging by a record which ranges from exclusion of Black and brown communities from financial services to their predatory inclusion, Wall Street doesn't give a damn about banking unbanked and underbanked families. The same goes for Facebook, by the way. Second, Wall Street isn't set up, and it has never been set up, to make the kinds of investments that will close the racial and gender wealth gap in this country, or even respond to climate change. If you care about structural inequality, if you care about white supremacy, if you care about dismantling the patriarchy, hell, if you care about not swimming to work, then you need to care about finance. And if the current financial system is set up to extract, not to invest, then we need a new system to return all that wealth to the communities that created it. We are living in a moment that demands that we think big. And I say this very humbly, that we inspire people. We have to be ambitious in attacking the root causes, like the creeping financialization of our economy, or else we're going to squander the genuine appetite out there for systemic change. So that's the optimistic part. I am actually really, really excited to hear from this incredible group of speakers. They have big and they have inspiring proposals. However, some of them are already law, and others don't even need Congress to get going. So we're going to hear from them. Before I turn it over to Alexis, some quick housekeeping. We encourage you to follow along on Twitter. Silence your phones, but follow along. Our Twitter handle is @TakeOnWallST, and the hashtag for this event is BankPublic. Help yourselves to food. Bathrooms are in the back to the left. There are unisex bathrooms and men's and women's up the stairs. And with that, I'm turning it over to Alexis.
Thank you, Porter. Can we get a round of applause for Porter? All right. Good morning, everyone, and thank you for coming. I'm Alexis Goldstein. I'm a senior policy analyst with Americans for Financial Reform. And we are joined by a wonderful, distinguished panel of guests that I think I'm personally very excited to hear from, and hopefully you will get a lot out of too. And we're basically, so where we're at, sort of Porter gave us these sort of opening comments. In my mind, we're at this moment in time where we've seen this incredible trend towards privatization of our entire economy, growing concentrations of power among the financial sector, and with that, immense changes sort of away from the power of working people and towards the power of corporations. But in this panel, we're going to talk about a different approach and a whole series of different approaches about how we might reverse that trend and look toward a new model that is more public-facing and more focused on things like public investment and thinking about things like public goods and how can we build moonshot projects that take multiple years that private investors may not be interested in. So to my right, just to introduce everybody, we have Marcus Stanley. He's the policy director at Americans for Financial Reform. He's going to give us some opening and framing comments. Then we're going to move to David Jetty, from the Innovate Capital Director of Business Development and Public Bank LA Legislative Director. He's going to talk to us about public banks. On the line, we have Mirsa Baradaran, who's going to be talking to us about postal banking. Now here again on the stage, we have Lev Menand, who's going to be talking to us about a proposal called Fed accounts. And last but not least, certainly not least, we have Saleh Omarova, who's from Cornell Law, who's going to be talking to us about the National Investment Authority. So I'm going to kick it off to Marcus to get us started.
Okay, thank you, Alexis. So I'm the one person on this panel who does not have their own bold, creative, and ambitious new public banking proposal. So in lieu of being bold, creative, and ambitious, I'm going to just try to give some broad framing thoughts that I think will help us in reflecting on the public banking proposals that we're going to hear today. And the first point that I want to make has to do with the nature of those proposals. Inspired by the evident failure of private financial institutions to effectively serve the larger public interest, we're really seeing a renaissance in thinking and activism about public banking today, and in general about public alternatives to Wall Street. But there's enormous variance in what these alternatives are targeted at doing and how they would work. Some proposals are aimed at providing basic transaction services to the currently underbanked. Other proposals are aimed at changing the flow of investment or credit. Some proposals are rooted in taking public control of state and local finances. Other proposals would engage the money creation powers of the federal government in order to completely transform the entire national financial system. Some proposals implicitly rely on modern financial technologies. Other proposals are more traditional. I would suggest that there are many ways that these different proposals and projects could inform each other and gain from each other. For example, projects that focus on providing transaction services to the public face the issue of how to invest or recirculate the money they get in transaction accounts. A natural answer to that is that some of these funds could be used as a form of publicly controlled reinvestment in underprivileged communities and pressing economic problems. Projects that focus on taking control of state and local finances are more advanced politically and more rooted in local political constituencies than some of the national scale ideas put forward by academics. But they also face the natural fiscal limits of states and localities. Combining these ideas with the power of the federal government to provide technical infrastructure and a credit backstop could benefit both sides. So the first point is that we should look for complementarities in the ways that these different proposals could inform each other. The second point I want to make is that we should not view public banking as something extreme, unprecedented, or politically implausible. Public banking, or at least public support for and management of financial services, is already all around us. Our housing market is underpinned by a massive system of federal loan guarantees and credit support that directly sets critical underwriting rules for most of the home loans made in the U.S. Federal transaction infrastructure and deposit insurance are essential to the private banking system already. The U.S. higher education system could not exist in its current form without direct federal lending to students. On a transactional level, many transfer programs already provide what are effectively free accounts to benefit recipients, just because that's the most efficient way to operate. What's more, many of these existing public banking adjacent programs are very politically popular and even have bipartisan support. And that should make us think about the real political possibilities that already exist for public banking. Unfortunately, it's also true that many of these programs haven't achieved the public benefit that one might have hoped for. All too often, they've been captured by powerful private interests, transformed into subsidies for private Wall Street entities, or limited just at the point that their expansion might have greatly benefited underprivileged groups. We should give more thought to the project of public banking in terms of building on these existing projects and combining them with some of the innovative ideas that are coming out. All right, so with that, I will turn to those innovative ideas.
I believe we're going to go to MRSA first, is that correct? So we're going to go to MRSA Baradaran, who's joining us from the University of California, Irvine, and has woken up very, very early to be here. So MRSA, thank you.
Thank you.
And we're turning to you to talk about postal banking.
Thank you. Can everyone hear me and see me okay? Yes, okay. Wow, sorry about that's a lot. I want to talk first about public. Can you hear me okay? Yes, okay.
Yes.
just to frame it, and Saleh and Lev and others can talk more to this later, but all banking is essentially public. So the FDIC fund insures all of our deposits. The Federal Reserve, all of the credit programs sort of undergird the economy. There's Fed loan guarantees from the GSEs and all sorts of things. So there's this whole public infrastructure that undergirds the banking system. So to say public banking is to just recognize that all banks are essentially run by the public itself. And so what I think our job on the panel is to show how to make that more egalitarian and more equitable for those who are left out by the private decision making of some of these intermediaries that are actually running by the nature of the public. So I think postal banking is one option in a slate of many public banking proposals, and the idea here is that you have lots of unbanked communities, lots of unbanked individuals, and underbanked as well. So people who don't have access to a bank account, people who have to go to payday lenders to make it from one paycheck to another, and the postal bank would be a place where you would get a financial sort of a checking account, right? So you would do all your financial transactions there. You would get a debit card, there'd be an ATM, you'd have a savings option, small lending, and then a rollout of other things as well. And this is actually not a bold, radical idea at all. We actually had it in the United States from 1910 until 1966. And it worked. It works in practically every developed country. And the reason why it works is because the post office is goes to every community regardless of cost, and it goes to communities in the rural West, down south, where banks are now not in because of the mergers and the way that they've shut down all these branches. So this is an idea that is kind of like really low-hanging fruit as far as the public banking sector goes, and I think you really can use the post office as in a big or a small way as want. You talked about the benefits. One way to do it is to just directly deposit EITC credits or any public benefits through the post office account, and then you'd have to opt out if you wanted to. Another way is to actually run a lot of these lending programs that the banks operate right now. Just send it directly to the post office, not make it go through the banks. So there's many ways that you can use the post office, and there's this long history of the post office actually being a banking institution. So that's that proposal, and I'll be happy to jump in more as others propose their topics.
Thank you, Marissa. We're going to move now to David. He's going to talk a little bit more about public banks.
Thanks very much, and thank you to Take on Wall Street for having me and for holding this great panel. My name is Dave Jetty. I'm here representing Public Bank Los Angeles and the California Public Banking Alliance, of which Public Bank LA is a member. Public Bank LA was formed out of a divestment movement in LA called Divest LA. A lot of activists came back from Standing Rock, and after seeing the police presence and action that was used to defend that pipeline, and even kick those people off of their land and assault those water protectors. People came back to Los Angeles, to cities all over California, and wanted to know who financed both the project and the police presence. And unfortunately, there were two answers to those questions. It was Wall Street that financed the pipeline, right? Wells Fargo was a major bundler of that project. Actually, only contributed a single digit of actual finance capital to the project, but bundled all this private capital together to make the pipeline possible. And there was the Bank of North Dakota that actually financed and helped some of the emergency funding to respond with the police presence there. So we got a harsh lesson about the state of finance and what it's used for, and the kind of touch points that money has on society, and how entangled it is with the structures that oppress working communities, indigenous communities, and cause harm to the environment. The desire was then radicalized a lot of folks and got them to join divestment movements demanding that their cities divest checking and transactional services, debt accounts, all manner of banking services from Wells Fargo in particular, but also any banks that might have participated in that kind of infrastructure, energy infrastructure or police investment in police or lending to police or military equipment and prisons. That movement was successful. Los Angeles was successfully lobbied to disqualify Wells Fargo, not because of its participation in this kind of financing, but because of its subsatisfactory CRA rating, which they earned by defrauding their own customers and opening lots of accounts in people's names without their permission. This was a technicality the city was willing to overlook until it was brought to their attention by activists, and even then did not immediately cancel their association with the bank. Why? Because there are no alternatives to large-scale Wall Street institutions when banking public money. Public money must be collateralized to, in California, something around 110%. So the push instead was to create a permanent alternative in the form of public bank. Cities can't do this alone. City efforts certainly can't, so we banded together and made a statewide alliance to pass AB 857, and we were successful. AB 857 permits local agencies, namely cities and counties, to open public banks. These banks are more defined by what they can't do than by what they can do. They are commercial banks, but they have heavy limitations. And I'm sure that we're going to get into some of those. Certainly, I'm glad that we're starting at the local level because it's these big national policies that I'm sure most people are here to talk about that are going to make the big changes for climate and working folks. But for us, we're looking to increase credit at the local level and to divest our local cities and counties funds from these extractive finance practices. Our banks are limited from retail interactions with consumers or businesses and are forced to work through credit unions and commercial banks, CDFIs, things like that. But we're confident that the banks will create an alternative capital source and organizing function for local banks and for nonprofit banks, and hopefully increase credit to the unbanked, give them transactional services they need to interact with the internet and interact with the state, and to increase the circulation of money in local communities. But we absolutely need federal help in those areas. We need the FDIC to treat us like any other commercial bank and not to give us any kind of special scrutiny that would disqualify us. And we absolutely need federal partners, especially in the form of postal banks or direct federal public banking that could create a nationwide network of these institutions.
Thank you, David. I should say that I happened to be in California in Sacramento on the day that there was the hearing that included public banking, and it was a very impressive coalition of folks that all came out to support that bill. I was actually floored at how many people came, so congratulations on passing that bill. So we move now to Lev from Columbia Law School, and he's going to talk about a proposal called Fed Accounts.
Thank you, Alexis, and thank you also to Porter and to Lisa for inviting me to participate this morning. It's great to be here. As Marcus and Alexis mentioned, I'm going to talk about a plan that Morgan Ricks, John Crawford, and I put together for public banking that we call Fed Accounts. Each of us came to this project from different places, but for me, the impetus was actually reading Saule's work and hearing Marisa speak about postal banking at the Treasury Department in 2016, so it's very fitting that they're both on the panel with me here today. Marisa's proposal seemed like a great idea to me when I first heard about it several years ago. And I wondered whether the best way to do it wasn't to use the government's own bank, the Federal Reserve. The post office could still serve as the retail front end, housing ATMs, offering teller services, but the Federal Reserve would run the back end and maintain the balance sheet. After all, the Federal Reserve is a bank, it's owned by the government, and its balance sheet runs into the trillions of dollars. For those of you who are less familiar with the mechanics of our monetary system, part of this balance sheet is currency in circulation. That's the green stuff we carry in our pockets. The other part is bank accounts. And these accounts are great. They pay a high rate of interest, currently 1.55%. Payments between them clear instantly. There are no predatory fees. And there is full government backing no matter how large the account balance. The thing is, people like you and me cannot open these accounts. US law restricts access to them to an exclusive clientele consisting mainly of commercial banks, but also of foreign central banks, the US Treasury Department, and various other governmental entities. Basically, Morgan and John and I think that in this digital era, there's no longer a good policy justification for these restrictions. So our proposal is for the Fed to open up access to these accounts. We call the new accounts Fed accounts, and they would have all the functionality of ordinary bank accounts, with the exception of overdraft coverage. They would come with debit cards for point-of-sale payments and ATM access. They would support direct deposit and online bill pay. Account holders could access their accounts through the internet or through a mobile phone application. There would be a customer service number. While the program would include some transition costs, the benefits we think would be staggering. First, Fed accounts would be a money and payment safety net for all Americans, lessening reliance on expensive and subpar alternatives. Offering bank accounts costs money, which is part of the reason why commercial banks today aren't interested in banking people with small balances in their checking accounts, and why when they do, they often hit them with predatory fees. The costs include the fixed expenses of maintaining and securing a website, fraud prevention and mitigation, verifying identities, combating money laundering, and other illegal activities. Fed accounts would use the returns it earns from maintaining larger accounts to pay these costs. It would cross-subsidize. This is actually our normal approach to providing critical infrastructure. We don't charge the people living on each city block for the sidewalks. We build sidewalks everywhere out of general revenue. The Fed would do the same for money and payments. Fed accounts would also hold appeal at the other end of the income and wealth spectrum. The interest on reserves rates would be very attractive to large businesses and institutions. And if adopted on a large scale, Fed accounts would bring about profound systemic changes. Financial stability would be dramatically enhanced. Monetary control and monetary policy transmission would improve. Current problems with pass-through of policy rates would diminish or disappear. And because Fed accounts would not charge interchange fees on debit transactions, they would put downward pressure on implicit taxes on retailers and consumers. Far from being fiscally expensive, we expect Fed accounts will generate revenue, possibly a lot of it, while imposing minimal user fees. One of the great byproducts of the Fed accounts program would be that it would allow the public to recapture the returns that accrue to money creation. And by providing digital money directly, the Fed account program would increase the central bank surplus by tens of billions of dollars annually, and that money would go to the Treasury General account. So there's much more to say about the practical aspects of designing and launching the Fed account program. But let me just conclude by putting the proposal and this whole conversation into historical perspective. Private banks used to issue basically all the paper currency in the United States. Then we created the Fed in 1913, and it soon displaced private bank paper. We think that was a good thing. Providing paper currency was a natural role for government, a public good. It would be sort of silly to think that this was the end of history for the government's role in supplying money to the public. We now live in a digital age. Most payments happen digitally. The Fed offers paper money. Why not digital money? That's what a bank account is, digital money.
Thank you. Is this on?
Yes.
All right, so our proposal, mine and my colleague Bob Hockett's proposal, takes us a little bit onto a different problem, which is structural. So there is currently too much private capital in the financial system that is chasing yield and fuels speculation. At the same time, a lot of critical public infrastructure projects simply do not get funded because there isn't enough money. That's because private capital doesn't feel safe enough to invest in such projects, partly because they cannot control all the risks over the long term, that these projects require, but partly because they feel that they cannot capture all the benefits that such publicly beneficial projects will produce. So how do we solve this problem? Our solution is we need to create a new public instrumentality. We need to create a public agent that will act directly in the financial markets and act in our collective interest, but channel a lot of that extra sloshing around private capital into long-term, capital-intensive, but publicly extremely beneficial, employment-producing, growth-inducing public infrastructure projects of all kinds. So we call that a proposal, the proposal for the National Investment Authority, NIA. Think of it as the New Deal era's Reconstruction Finance Corporation, RFC, meets BlackRock, right? And so that would be structurally a hybrid institution, and it would be sitting in the federal system right between the Fed monetary policy and the Treasury fiscal policy. And it will also be a hybrid because it will operate not as a regulatory agency, but as a directly market participant, as a hybrid, right? Basically creating public-private partnerships in order to channel money into the projects that we all need. Except, unlike the typical public-private partnerships we used to, it will not be the model where there's public money and then private quote-unquote management, which is basically mismanagement of that money, right? It will be the other way around. It will be private money managed by the public institution. So we have a paper about it, and we have a white paper about it that sets out the complicated structure that we create for that NIA. But for our purposes right now, what's important to understand is that think about what that public BlackRock would do. So the NIA will essentially set up a number of funds, just like venture capital funds, private equity funds, following the same exact system. Solicit money from insurance companies, pension funds, sovereign wealth funds, all of those institutional investors that are currently looking for quote-unquote safe assets backed by the US government's full faith and credit, but don't have enough assets to invest in. So they will be solicited to become limited partners in those funds without any control rights over what the fund does. Now the NIA asset manager team, those bright guys who go to business schools at the University of Chicago or Wharton or whatever, will be hired to run those funds, right? There will be auctions on regional basis with regional offices, auctions for proposals from public entities, from private companies, from, newly created cooperatives to create various infrastructural projects, right? Like green economy kind of stuff, high-speed rail network, maybe centers for re-education and reskilling of adults that are misplaced from their jobs by technology, so on and so forth. Pick the projects, put them in the portfolio, get equity interest in those companies, in those projects, just like any private equity fund will do, and run them. Lock up the money of those investors for 7 to 10 years, just like private equity funds do. And use the beauty of the proposal is that we can use the full faith and credit, the backup of the federal government, for example, to sweeten that investment to the private investors by, for example, guaranteeing the return of the principal to them upon the expiration of the 10-year lockup period, perhaps, right? And also to promise them to pay a variable equity-like return that is linked to the projected long-term benefits to the national, regional, local economy of that public infrastructure project that is sitting in the fund, even though those benefits cannot actually be monetized by private investors today. We can do it. It is kind of like paying interest to the private investors for agreeing to help out in financing the projects that otherwise they would stay away from. So this is the crux of the proposal, and we think that in the long run, not only will it target that current mismatch between what the financial system does and what the real economy needs, but it would actually change the political balance of power in the society if we don't depend on private investors deciding what does and what does not get built. Thank you.
Yeah, let's hear it for all our panelists. So it strikes me that even though there's sort of a group of proposals specifically about banking and the National Investment Authority, everything in a way is about deploying federal resources to improve financial outcomes, right? And it seems that the situation we have now is that the profit motive is driving both predation when we think about just individual banking transactions, right? things like overdraft fees for people that don't have very high balances, but it's also driving poor planning. Because as Saleh mentions, right, there's this search for yield, and unfortunately investors typically are completely uninterested in 100-year-long investments. And I think we are sort of in this period where we've had a long set of sort of messaging that, oh, well, Wall Street can fix everything, and if we just turn everything over to the private market, they're smarter, they're faster, they can adjust quickly, they're agile. And I think all of these suggestions are basically saying, well, actually, there is benefit to doing something with the reach of the federal government and federal agencies. But I was hoping maybe, and I feel like I should toss to Marissa first just because it's a little awkward and you're on the line, but to talk about a little bit more about some of the benefits that doing this through a federal system or a local system, so for you about postal banking in particular, like what are the things that are able to be achieved that perhaps private actors might not be able to do?
I think you actually hit the nail on the head with the long-term investing, and what Saleh and Lev have talked about is just the ability of the federal government to be able to park money in something for 10, 15, 20 years and see that yield come in. I mean, with postal banking, for example, you have actually a whole infrastructure that has been set up since the 1790s, and so you actually don't need to retool, create some new product or anything. All you have to do is use the sort of, the tools that are already available to put public money and divert it somewhere else. And on the investment front, the federal government has the ability not just to use the infrastructure that's already set up, but to, wait 10, 15, 20 years for that investment to come back. I mean, Saleh brought up broadband, right? Broadband is a really great public investment that ends up like yielding a lot more than you do putting in to just laying the tracks, right? So once you have broadband, you can actually get a ton of jobs, get banking services and all that stuff. But to get a private investor to put broadband in a city is a hard, it's a hard sell, because where are the immediate payoffs? So you have to sort of get the shareholder model to approve of something that maybe not that may not have direct profits for at least 5, 6, 10 years. So this is where public banking is really geared toward those kind of long-term investments, like what they're talking about the North Dakota Bank as well, right? You use the resources of the state and kind of put it back in for the people, as opposed to like laundering it through JP Morgan and their shareholders and then hoping that it trickles back down later. Lev and Morgan's paper really talks about that interest on reserves, right? The Federal Reserve pays banks and hopes that they take that money and just kind of trickle it down. It's a trickle down economics in a sort of banking context. And here I think we're all saying just cut out that whole middleman and just send it directly to the places that you want to use the economy or to put resources in.
Does anyone else want to weigh in?
Yeah, I'll say really quickly, as someone who's building a middleman in this potential system, I have to acknowledge the drastic asymmetry between something like the federal government, which issues its own money, has treasury accounts that can be negative, and all these things, and the states, and then even smaller than that, cities and local governments and counties that we deal with public banking in California. It's vast, right? Federal government's not restricted by the amount of money in the bank. It's restricted by real goods and services in the economy. We can absolutely direct that power toward instant change, the kind of equity investment that we absolutely need. Our banks are, in California under AB 857, are not going to be capable of doing that. They can't just issue money. But they can get access similar to other Wall Street institutions. So they can get a Fed account as a bank, and this allows them access to this window, which is available to private citizens who have the qualifications to open commercial banks. But it was not available to governments really until we passed this law, and it's still not guaranteed, right? The FDIC is going to need to approve our banks, and the Federal Reserve is going to have to grant it a master account before it can have access to this window to this cheap way to borrow money. or the reserve interest that's paid when they deposit money. The reason why we are organizing at this granular level, even though the big change can happen at this federal level, is because we also want people to be able to influence this policy on a direct level, right? Not everyone can come to Washington, D.C. and make their voice heard. So the way that these plans roll out will depend on very intelligent people gaining national support across a lot of constituencies. But we're on the ground as far as seeing how credit can improve affordable housing, or specifically housing for no and low income people. Credit is not going to solve that problem entirely, but we can't depend on federal banks, whether they be public or private, to understand that situation all by themselves. We need to have local institutions that have access to a money system and can deploy capital to their communities in efficient ways that can be influenced by the people that actually live there on a granular level. And that distribution is going to make these banking systems more robust and less monopolistic. And we can have a lot of faith in our economists to kind of understand when inflation might come from a big banking effort like this. But you don't know how to turn that money into goods and services unless you're at the enterprise level, which a lot of our public banks are likely to be.
So I wanted to ask a different question. Marissa mentioned that postal banking is not a new concept. I think we hear this a lot in a lot of spaces, right? The free public college debate springs to mind. Like, people act like this is something that's never happened ever in the United States, and it actually did in California before Ronald Reagan became the governor. But I was hoping, Saleh, if you could talk a little bit about the sort of historical precedent. I know that your proposal is different than what's been done previously, but in reading your paper, I remember that there are examples of investments from as small as, like, I think a barber shop in Detroit to things that are much, much bigger. So I was wondering if you could talk a little bit about what.
Oh, of course. So, here in the States, we've been accustomed or told or, taught to think that, the American economy is purely a result of just purely private capital investment and private initiative. And of course it's not. And Alexander Hamilton, the first Treasury Secretary, for example, right, famously, he was the one who sort of envisioned the national bank and all of that stuff, but he also had an idea for a national development bank, which was sort of his idea of a public-private partnership, specifically for the promotion of manufacturers at the time, right? Guess what? We're in the 21st century, and we should worry about the promotion of our manufacturers. So the RFC, in our paper, we actually lay out the experience of RFC, the New Deal era's Reconstruction Finance Corporation. That was one of the best examples of how a public instrumentality, a federal instrumentality in the States, has taken over portfolio investments, not only through credit, but actually investing in equity of a variety of businesses throughout the country in different regions to support their the efforts to get themselves out of that Great Depression problem, right? And RFC has become literally the largest, in terms of its assets, the largest asset manager in the United States at the time, dwarfing all of the assets of all Wall Street together. RFC was the parent company of all these Fannie Mae, the Exim Bank, and a lot of other Small Business Administration, a lot of other institutions like that. And it was taken out of existence only in the 50s, precisely because it's become so successful. Because then the push was like, well, we don't need it anymore, right? We need to privatize it. So our point is, look, we've learned so much from that time, and then we forgot all of it. We need to recreate that tradition on a new level. Actually, we're very sympathetic with Lev's and Morgan's proposal about Fed accounts, because we think that NIA issuances could actually be sitting on the asset side of our own Fed, our own Federal National Bank. And all of our money that will be on the liability side as deposits could actually go into building something we all can use and our children and grandchildren can use. Thanks.
I have another question. I feel like a lot of these proposals are very ambitious. We have a somewhat difficult situation in Congress where it is very hard to pass legislation. So I wanted to ask the panelists to weigh in on whether your proposals either in full or in part could be done through executive action, or if they would require legislation. Looks like we're going to go to Lev first, Mirza, but we're going to come to you, I promise.
Okay, no.
So, I mean, unfortunately, it's sad to report that almost certainly our proposal would require an act of Congress. Congress designed the Federal Reserve System and its 12 Federal Reserve banks to function as bankers' banks. And so Section 13 of the Federal Reserve Act specifies the various entities that the Federal Reserve banks can take money on deposit from. And these entities, as I mentioned earlier, they're primarily banks, although also government entities. The Fed has actually wriggled around this statutory scheme and figured out a way to offer what are, in essence, bank accounts to some entities that are not on the list of Section 13, namely money market mutual funds. And the Fed banks money market mutual funds through its overnight reverse repurchase agreement program, ONRRP. It basically creates what is economically equivalent to a deposit account using purchase and sale of Treasury securities, and it uses its Section 14 authorities to do this. The statutory basis for this program is questionable, and in the distant past, various members of Congress have actually complained about it. So it's hard to see Congress looking the other way if the Fed tried to use its Section 14 powers to offer bank accounts to all Americans. So I think that unfortunately you would need legislation, but I think there's lots of reasons to believe that legislation could be quite popular. Basically, everybody in the economy except for the incumbent banks would benefit from the Fed account program. It's not just a program that would benefit unbanked and underbanked populations. It would benefit homeowners, it would benefit the middle class, and it would also benefit very large and very powerful corporate interests in this country. Companies like Apple that have huge amounts of cash to manage would be enormous beneficiaries of being able to have an account at the Federal Reserve.
Mirza, why don't we jump to you?
Yeah, so there's a route to postal banking through Congress, and then there's one without Congress. And I think there is a way that through the post office itself, through the board of directors and the postmaster general, limited postal banking can be rolled out. Tomorrow, although the post office isn't really likely to do it tomorrow, there are plans on the table to privatize the post office. And so I think that there's a debate right now for like the very public nature of the post office itself before we even talk about postal banking. So I think there are some political barriers there, but I also think there's a way to justify sort of legislative powers here, and that is to talk to the red state Congress and congressmen and senators, and to say, look, you are the people losing your bank branches at a alarming rate, and so there's a whole swath of the country, a very red state country, where you don't have a bank within 50 miles, and you have to drive to a ATM and pay $7.50 to get cash. And so I think there is a coalition to be made in Congress, but there's also a way around Congress to do both.
Yeah, just sort of picking up on that, I think there are a lot of cool, we here operating within DC, we know a lot of cool administrative end runs that can be done to do things, sometimes quite valuable things. But I think if you want to do something and have it stick on a large scale that really does something transformational, you almost need that political legitimacy of some congressional action. Because the people, the private sector, they have the legitimacy of profit, which is the God in our society, and they can manipulate the administrative system in a lot of ways. But we need that democratic certification. And I was really happy to hear what Mirza said about red states there, because one big dimension of inequality that really grew during the financial crisis, we pay a lot of attention to race and class inequality and how that grew during the financial crisis, but geographic inequality has grown enormously over the last 10 or 15 years. We have 60 or 100 counties growing very rapidly on the coasts, and those areas have their issues and problems, but we have huge swaths in the center of the country red states, but also very multiracial areas around the Great Lakes and in the Southeast that are being left behind. And those areas are, A, they're overrepresented in the U.S. Senate, for better and worse, and B, they have huge amounts to gain by rechanneling investment and putting modern infrastructure, banking infrastructure into their areas. So.
Well, I don't want to front run the next panel, but I wonder, David, if you could just talk very briefly. I believe we're going to talk about this again in the next panel, but if you have any quick tips, and then I think we'll talk about it more in the next panel. But you have passed a bill and built a very broad coalition to do so. So do you have any suggestions for us?
Yeah, not me, but
the
large
state
group
of
of
California
organizers.
has passed.
Yeah, California has a lot of individual groups, and we're working really well. It's a blessing to have all these great organizers to work with. We have the advantage of having a fairly uncontroversial issue to organize around. Most people in government, even much less the public, don't really know what public banking is, and so we have the opportunity to introduce it to a lot of folks, and it answers a lot of questions that especially progressive organizers have, the how do you pay for it type stuff, but also what is we have a realistic material basis for how we're going to solve some of these problems, and it's vocabulary that a lot of organizers really appreciate, and I think it's given people something to really organize around. We managed to pass the law because we found great sponsors. We had a broad coalition across lots of both cities and rural areas and suburbs, and we had a very limited bill, right? We did not try to lay out the structure of these banks from the beginning. We left it up to local counties and cities to form the banks that they were going to need to solve the problems they wanted to address and to structure them the way they wanted to, with some limitations, right? They had to put forward governance plans that didn't have obvious conflicts of interest, but there's no requirement, for example, that they represent underserved communities, right? We didn't go to bat necessarily for limitations on investments in fossil fuels. These are things that were really important to our coalition, but we made the decision early on to have as lightweight of a bill as possible so that we had the highest chance of getting this through, partially because we know that we can influence our cities and counties more directly, and that the biggest banks are likely to be in the places where these issues are most important, so that even if we end up with some flawed banks, the majority of the system is going to be an alternative that we can rely on. And then to answer the federal question, we don't need any real laws passed in DC. We need an FDIC commissioners to treat us like they would other banks and not consider us a higher risk to the insurance pool than other banks, especially considering almost all of our deposits to be fully collateralized. And we need the Fed to treat us likewise. And honestly, if a postal bank was given access to the Federal Reserve, then they could issue some of these accounts and try to act as an intermediary. Obviously, the intermediary may not be necessary, but the kind of local touch that we're talking about can be provided by postal banks, by public banks, in a network that tries to minimize the friction for people's access to that Fed window and the creation of money.
So I want to ask one more question and then open it up, which is, let's say we wave a magic wand and all these proposals come to be tomorrow. We've obviously had this market dominance of Wall Street for so long. Their capital is everywhere. It's in parking meters in, I think it's Chicago. It's in Fairway grocery store in New York City. All of a sudden some of this money perhaps moves out of those institutions where they're charging these predatory fees and into Fed accounts or into postal banking. Like, sort of what happens next? Are we going to then see that capital flow to the National Investment Authority? And what can we do if that happens, right? Because a lot of this private money is kicking around doing very damaging things. You mentioned Standing Rock and the pipeline. What happens if there's perhaps these things come to be? What do you envision happens?
So it's not like these are necessarily discrete things. You do one, and then tomorrow somehow the world changes. I think the proposals that we're talking about here are structural proposals, right? We need to restructure the way finance moves around the society, for what purpose it moves, right? So my sense is that if you actually insert the federal government or public instrumentalities at a variety of levels, in addition to the federal government, directly into the market and start creating these new channels for investment of money, our money, because remember, those of us who are lucky enough to have 401ks Every month, we're sending a part of our paycheck into that capital markets, and who knows where that goes, right? But if the federal government creates new channels for taking that money and utilizing it for the public good, then the private financial institutions, private asset managers who used to take all of that money in and make their own decisions in the interest of their own shareholders will have a lot less money to play with. If they have less money to play with, they will shrink in size. They will also start looking for niches in which the federal government specifically is not interested in going, like higher risk investment of a smaller scale. And that's where that money should go, right? You know, if I have extra money, in addition to my pension that I don't want to risk, I would put that extra money with BlackRock or with Citadel or with whatever it is, some hedge fund, some private equity fund. Let them invest it in some kind of high risk startup somewhere else and see what pans out. So we change the structure, we change the field, and we will change the dynamics. And then we won't have to worry about, do we need the Glass-Steagall Act again? Do we need higher capital regulations of banks? Things will change in the market itself in ways that we cannot currently even anticipate. Why? Because we don't allow ourselves to think big.
I'm not quite as optimistic in the sense that I think we have to think very, very carefully about institutional design of these new public banking entities that we create. We have to think, as David said, about things like local voice and community voice and how that's heard, because one thing, like I've been working on financial regulation for now like a decade in DC, and one thing that you realize is that in the back rooms of institutions, regulators get captured. If there's not a public and democratic voice, regulators get captured by industry. And we've already seen, student lending permitted in some of the worst grifters and con artists in the economy, and it's been incredibly difficult to drive them out. So I think we really do have to think about how we design institutionally these things to be accountable to the real public and real communities.
Do you want to talk about your advisory board?
Actually, we have been thinking about it, Marcus. Seriously. We have this whole kind of, we've thought about it very seriously. There is never going to be a foolproof sort of ideal structure where everybody will just, get rid of their memories or our current experiences with corrupt government. But the government today is corrupt, fundamentally because the balance of power in the system structurally skewed toward private interests, because the government has been told for decades and decades, look, you're too stupid to play in the markets. You have no idea how to invest. And therefore, you just sit back and listen to us and we'll tell you what to do. So, for example, for the NIA proposal, right? Yes, we are fully on board with local voice and regional voice. And that's why we propose that the NIA will have regional offices. And regional offices, just like RFC had back during the New Deal era, those would be the hubs for actually soliciting and encouraging new local initiative on what does this region, what does this community need, how can we leverage these communities' voices together and put the federal government's money to it, for example, right? And in terms of the accountability, we need to think creatively about accountability. So we propose, for example, to set up a public advisory council, people like us, that would be advising the NIA at the highest level of national developmental economic strategy about what needs to be done. So it's not just about, some quantitative growth of markets or anything like that. So I'm completely sympathetic, Marcus, to your concerns. But, we are thinking about it. And my hope is that you guys will actually take the time to read what we've written. And, please let me know if you see any glaring problems or if you have any suggestions. I'll be very grateful.
Marissa, can I ask you, what do you envision should we be able to enact postal banking?
Well, I was actually just going to follow up on something Saleh said, which I think is really important, is changing the narrative on what governments are capable of doing and what they're not capable of doing. I think part of the thing that's been happening since, Nixon, but Reagan, right, is this idea that government is always bad and that the best thing that the government can do is stay out of the market. Yet, any of us who work in banking know that the government is already embedded in these markets. They're making these markets. And so to tell that narrative differently, I mean, taking a page from the playbook of the right, the way that they have discredited the post office is, oh, it's losing money, it's so inefficient, it's expensive, blah, blah, blah. It's a dinosaur, it's ready to go. And that's actually not true. They do a lot of the deliveries, that UPS won't do. They're very efficient, they're very trustworthy, and their financial problems have more to do with politics than they do with technological advancement. When you say, look, this is a dying institution and you don't allow it to innovate, then it is going to be a dying institution. So these narratives end up being self-perpetuating. When you say the government only does bad things in the market, then the government, becomes corrupt and bad. So I think there's a way that when you create a narrative, you actually end up self-perpetuating that narrative. And so I think part of our job, this is what's great about AFR and Take on Wall Street, is just to tell different stories about government and people and what markets can and can't do, because I think we have this idealized view of the market contrasted with this, very pessimistic view of the government, and the markets aren't all that great, and the government is not all that bloated and inefficient. So I think we need to change that narrative.
So with that, I'd like to open it up. I believe we have some mics. We do ask that you speak into the mic so that the folks on the live stream can hear. I see 2 questions over here. Can we start over here at this table right there? This woman.
Good morning. Just make sure it was still on. My name is Brittany Austin. I'm with Action Center on Race and the Economy. And I had a question about the NIA. I sort of wrote it down, so I'm going to read from it. Seems like much of these funds exist already because there's just this excess of non-productive capital, right? So these financial firms have this non-productive capital that they're constantly trying to move around. And the creation of that excess is sort of where I see so much of the exploitation happen, especially coming out of like the labor movement and the research that I've done there. And I just wanted to know how the NIA sort of sees itself intervening with the exploitation of workers or renters if these firms are still existing, even if we're changing the way the capital is used.
So a lot of the institutional investment capital that is currently, in the financial system is actually, mutual funds, pension funds, insurance companies. Yes, the money is a result, it's produced in the process of production, the way it's organized under our current capitalist system. The NIA is not really trying to change the industrial relations on the ground. However, if the NIA is the shareholder, the controlling shareholder of various private operating companies on the ground, like electricity companies, manufacturing companies, agricultural companies, and whatnot, the NIA is not a blood-sucking, sort of private profit-seeking shareholder, right? They can actually create a different set of relationships on the ground, because it's like, when you work for the federal government, it's a little bit different, I would assume, than when you work for a Wall Street firm, right? The way you are relating to your employer and the way your employer treats you. So in the very same way, the NIA will actually start making changes on the ground, and that can trickle down in terms of the culture of what a decent, humane workplace should look like, a lot more effectively than any kind of, sort of kind of moral appeal to correctness. That would be my answer. It's very difficult to kind of draw a direct line that if we have an NIA, suddenly everybody will be an employee owner of the firm. But the NIA might actually encourage the creation of a lot more employee-owned enterprises because it will be able to finance it.
Hi, I'm Jennifer Cosleon with Community Change. Thank you all for this wonderful panel. My question is in regards to if bank accounts are created through the postal office. I'm curious to hear your thoughts on identification requirements for opening these accounts. Particularly, I'm thinking of undocumented communities and low-income communities, returning citizens who might not have the identification that is currently necessary to open a bank account. Can you speak a little bit about what your thoughts are around identification?
Yeah, so I think that's a really great question. And when I worked a little bit with Treasury during the Obama administration to actually put some of the practical elements into work. And one of the things that with the undocumented workers, they still have tax IDs, and they still a lot of people, most pay taxes, or they have some way of interacting with government for any sort of, they can do a driver's license without some of the documentation. So there are ways that you can use limited documentation for a postal account. And the idea here is that it's not a full-scale bank, so you aren't really worried about the sort of fractional reserve lending and all of that stuff. So the whole bank regulatory infrastructure wouldn't be on the post office. This would be minimal financial transaction accounts, the same way that you would get, prepaid debit card, payday lending. All of those requirements are very minimal documentation, and that the idea would be to do that to the post office. The address issue might be a problem. So, if you don't have an address, that might be difficult, but there certainly are ways that you can do it through an ID, the way that they do some of the EITC handout for disbursement.
So let me just jump in also. I think, Jennifer, that's a great question. There are two main reasons why undocumented people and various unbanked people are unable to open bank accounts. One is that the banks are not particularly interested in banking people with small balances, as we discussed, and as a result, they are not interested in investing in figuring out a solution to the various identification requirements. It's sort of a form of redlining. They know that this overall market is not profitable for them, and so they don't need to put in place steps to take other IDs and other forms of other methods to facilitate bank account opening for these populations. And so having postal banking or Fed accounts would fix that piece of the problem, because the government wouldn't be interested in trying to prevent these people from opening accounts. There's another piece of the problem, however, and there's no way around the fact that we have to solve that piece of the problem directly, and that has to do with the supervisory regulatory regime around anti-money laundering and counter-terrorist financing. The OCC and the Financial Crimes Enforcement Network, both of which are bureaus of the Treasury Department, set policies that all banks have to follow for verifying the identities of their account holders and monitoring how their account holders use their accounts. And so ultimately, the Treasury Department has to sign off on what the ID requirements are. And so what Marissa was referring to is during the Obama administration, there were a lot of conversations about whether or not the Treasury Department would take steps to help banks get comfortable with and approve various forms of ID that would be used to open accounts for undocumented workers, like New York City ID, various forms of municipal ID. And ultimately, we didn't get anywhere, but that's where the solution, that solution has to come from those organizations, Financial Crimes Enforcement Network and the OCC, around what the ID requirements are for anti-money laundering law, because whether it's postal banking or Fed accounts or even local and state banks, they will all have to comply under the Bank Secrecy Act with the regulations that the OCC and FinCEN have for Know Your Customer, and that's really that's where the rubber meets the road on that issue.
Hi, Joe Battistelli, the Coalition on Human Needs. I was wondering, and I use my cheat sheet, David, because you've actually implemented this at a local level, maybe, but if anyone has anything to say, how this functionally helps the poorest people of our society. Like, how this gets the unbanked into a system that allows for an ease of their own life, such as direct bill pay and other things, and how to move people who are fundamentally underserved by our current system into a place where it actually functionally makes their lives better and raises them up. And that, like, obviously the challenge is the transition. So with you having experience at a local level, like, how is that worked out, or how do you see that starting to work out?
So the most direct route there, I think you can see if you go down any street in LA that's not Sunset or Hollywood or Rodeo, you're going to see check cashing places, right? So you're going to see a ton of payday lenders, a lot of check cashing places, a lot of title lenders. These are folks who are making credit available to working class people who their only asset is their truck, or their only credit is the fact that they have W-2 income and it's coming, or maybe they don't even have that and they pay an even higher interest rate. The state can set limits on that kind of lending activity, but it actually reduces the amount of credit available to those people who are currently relying on it, because credit's a part of our everyday lives. The extension of credit is what money is. So it's my belief that we need public access to money, like a public utility, and that cities and counties can provide that interface because they have so many other interfaces with their citizens, especially working citizens that earn a paycheck and possibly pay utility bills, have rent, and have an address. But it's really people even beyond that penumbra that need even more services. So people who have no income, or people that have no address, and the problems by the BSA, KYC, anti-money laundering rules is the main hurdle there. But I think that some work between postal banks, public banks, the Treasury Department, especially under a different administration, might be able to give cities the ability to identify their citizens, possibly with biometrics, possibly through other interactions they have with public entities, where they can be extended a debit card. And a debit card where they can deposit their check for no fee, where they can spend it with no fee, they can use it on the internet, they can borrow up to some small amount in the form of effectively an overdraft fee, and that all that credit extension is cross-collateralized to other banking activities that are being provided to cities and city governments and local governments and union pension funds and city infrastructure projects, that all of that banking activity can cross-subsidize basic debit card services. I think that's how you get there right away, because then homeless people can buy things on the internet, which is going to change their lives. Being able to simply buy a Metro Pass. You can't do it with cash in a lot of stations. I mean, we've taken away people's ability to interact with basic goods and services. Half of LA doesn't even take cash. It's completely a wall. So you need to give them a debit card.
I'm just going to abuse my privileges as a moderator and say that I would not be in favor of biometrics as a condition of receiving a debit card. But I want to see, Marissa, if you want to get on this question as well.
Yeah, I want to be clear. Like, look, no, I am not under the illusion that postal banking credit is the answer to poverty and inequality. I mean, people need a living wage. People need to be paid more for working full time. So what we're talking about, a lot of the people that we're talking about in this population actually work, and they're just not getting paid enough to make it, from paycheck to paycheck. And so there are structural issues that cannot be solved by postal banking and debit cards. The trick here is to just at the margins where poverty hurts, to take some of that pain of being unbanked and underbanked away. And part of that is, to spend 10% of your already not sufficient income on financial transaction is just salt on the wounds, right? And it's also a payment that only poor people make. Bank fees and overdraft fees, all of that stuff is skewed toward the lower end of the income scale, and it subsidizes everyone else's free checking account, right? So people who have enough money don't pay those fees, and people who don't have enough pay it for the people who have more, right? And this idea of making people's lives better, it's not just the 10% that they'll be able to take home, it's the not waiting in line to pay their cell phone bill, not waiting in line to pay their water bill and their electricity bill during lunchtime in cash, because you can't send cash through the mail and they won't accept it. So you actually have to take your paycheck, put it into cash or a money order to pay for one bill, and then do it again for another bill. And so all of those nodes cost you $5, $10 to send money. All of that stuff just ends up just taking away at the already small amount of money that you have to work with. And that just seems like unfair and cruel.
I'm going to cheat and steal a number that MRSA put in her American Affairs article last year, which is that low-income people pay $89 billion a year in costs of financial services. I think that, you can correct me if I'm wrong, MRSA, but we spend only $70 billion a year on all the federal food assistance, on food stamps. So you're talking about an amount of money that's being drained out of low-income populations greater than the whole food stamp and SNAP programs. It's like, that's real. That's big.
Do we have another question?
Thanks. Hi, I'm Dave Cooper with the Economic Policy Institute. I've heard about public banking for a few years now, and every time I hear a presentation, I think, oh, that sounds like such a great idea. Why aren't we already doing it widely? And it makes me think, like, okay, is it that I'm just impatient and this conversation is just getting started? Or is it that sort of the political patrons of the industry is preventing this conversation from happening in the right spaces? Or are there arguments that the industry or the opposition is making that are resonating at least within some subset of the population? And if it's that third thing, I'd like to hear a little bit more about what those arguments are and how we debunk them.
So I think the conversation is just getting started, and I think that it's not the third thing, because until recently people weren't even thinking about this very much, and part of the reason why that is that money has dropped off the radar as a part of the national political conversation, and the structure of the monetary system has. But for most of American history, it was a major battleground in politics. In fact, for the first 50 years of our country, it was one of the top issues in the country. The first Bank of the United States, how the government would provide money. There wasn't enough gold and silver coins for people to pay taxes. That led to Shays' Rebellion. Alexander Hamilton wanted to solve that problem by creating a public-private monetary system where private interests would own the majority of single banking institutions, one for the national government, one for each of the state governments. And these institutions would create the money. They would be paper mints. And that was a huge political issue for 50 years. The first bank's charter was allowed to expire. The government created a second bank. Andrew Jackson basically destroyed the second bank, and Congress allowed the second bank's charter to expire. Straight up through the Great Depression, money was a major part of politics. Beginning in the 70s and 80s, money became a technical topic that we thought of in neutral terms. And people stopped recognizing the fact that money gets made collectively, and how money is made and who makes it have huge distributional implications. And the system we have today remains a public-private partnership, although it's quite a bit different from Hamilton's public-private partnership. Most of the money is made by private banks. People don't really recognize this. We still think that the pieces of paper in our pockets are the money, but there are actually very few of those pieces of paper. They're like the gold and silver coins in 18th century America. The vast majority of the money that everyone uses to buy and sell things and to store value are bank deposits that are made by private banks. And an awareness of that is a critical first step to understanding how the monetary system works and who it benefits. And private banks can expand the money supply within constraints set by the federal government by creating more deposits. And people don't recognize this, so they don't understand the power that private banks have, and they don't understand the implications of the monetary system that we have. I think a major wake-up call was the 2008 financial crisis. It has shaken the orthodoxy, and it actually destroyed many forms of private money, not private monies that people like you and I were using, but private monies that institutions were using. Lehman Brothers was creating private money by creating deposit substitutes. All of Lehman's private money disappeared, and in the aftermath of that monetary crisis, people are recognizing that the design of the monetary system is an extremely important part of governance. I think that, let me just say one word about part three, counter arguments. Part of the reason why we have a public-private monetary system is moneyed interests. People with lots of wealth are very uncomfortable with the idea of a monetary system with more government public control, more democratic control. And so Alexander Hamilton, for example, thought that the Bank of the United States should not be part of the Treasury Department because he believed that if the Treasury Department had the ability to expand the money supply directly to create more banknotes, that Congress would not do the politically difficult work of raising taxes in order to finance its spending. And so it was important, political economy point, that the Bank of the United States be independent of the government. Andrew Jackson, incidentally, thought that the Bank of the United States was a very bad thing because it allowed certain private interests to make a lot of money and to have a lot of control over the creation of our money supply. And he wanted to destroy the second bank, and he suggested that perhaps the Treasury Department should just do this directly. Unfortunately, his advisors and his political movement was not for that, and so that did not happen. Now, we have essentially a public banking system because the Federal Reserve does provide all of the base money and stands behind, through the FDIC, essentially all of the authorized, all of the money, the privately created money that Congress envisioned that would be created, basically the money created by banks. And so it no longer makes so much sense to allow the privately owned banks to capture the profits from creating money. You could still put in place safeguards if you were concerned about the government's spending, but there is no constraint right now in a fiat money system. There's no Hamiltonian problem. If Congress wanted to finance the government debt with money, it could.
So we are at time. I don't know if I want to give the two of you a chance to respond, but very quickly because we're already over.
I just want to say, I would put the counter-arguments into three major categories. One is basically incompetency of the federal government. We know that. The other one is the fear of political abuse of economic power by the government. again. And the third one is the typical one, perverse consequences, unintended consequences, and the fear of turmoil. So all of them are out there, they're powerful, but they also can be dealt with.
I'll tell you from the financial world and institutional investors, they understand perfectly the role of credit, and they understand that they have an advantage because they have access to this window. They don't want that to degrade. They see that inflation, especially post-crisis, has inflated asset prices, especially around monopolies. This is a great source of their wealth, and they don't want to see that diminished by redirecting it. At a local level, our obstacle is people's distrust of local and county governments. We have bankruptcies in the past in California that set very high standards for public deposits. We have homelessness, which everybody can see on their street. And an obvious question is, City Hall can't fix this. Why should I let them run a bank? But another big obstacle is that there is no tradition of public banking in the United States at the way that there is, let's say, in Germany, where you have people who are trained bankers, run regulated institutions, and are public servants and don't expect, 8-figure bonuses, right? But live comfortably and are working toward a public ethic around their investment policies. And we need to develop that, and this is, the beginning of that.
All right, well, can we give a round of applause to our wonderful panel? So if you have more questions, I encourage you, there's a lot of literature to be read from all of our panelists, books, papers. I encourage you to engage with it. I'm sure, hopefully they would welcome questions, perhaps by email if you engage with the paper. So Saleh, Lev, David, Marissa, Marcus, thank you all.
Okay, you guys, we're going to take a 5-minute break, which means 5 minutes. We want to get you out by noon, so go get some food, go run into the restroom. We'll see you in 5 minutes for the next panel.
Solid. Fred is off. I haven't been tracking the time, so let me see who's actually figured out when 5 minutes have elapsed. Oh, excuse me. Were you tracking the 5 minutes? Was I? What? Oh, sure, but no, I'm. Are you doing it?
To be honest.
And am I bringing big people back then? All right, cool. All right. All right, here we go. All right, everyone, if we could come back together. We're about to get started with our second half of the morning, folks. Excellent, excellent. Thank you. Welcome back, and welcome to the second part of our public public options to banking symposium. My name is Erica Taylor, and I'm the popular education manager for Take on Wall Street. Take on Wall Street, for those of you who don't know, is a coalition of over 50 community, labor, faith, and consumer organizations, and they've come together to work to build a financial system that benefits working families as opposed to the big banks on Wall Street and the wealthy elite. So there are basically three legs of the TOWS, Take on Wall Street. TOWS, could be toes, we call it TOWS, of the stool. The first is that we educate decision makers about the consequences of financialization and ways to counter that, to develop alternatives to create a more equitable financial system. We also work to inform the political debate, which is a way that we expand our impact. And finally, we engage in popular education, and that's my job. That means we train our member organizations and our allies so that we can increase our collective capacity to organize around Wall Street accountability, and we do all of that work in the context of, through the frame of a race and gender analysis, because we know that as people of color, Black and Indigenous people of color, and women who are have the most disparate impact from financialization. So we also have a day-long curriculum available on our website that we want folks to feel free to visit and download. And it covers this whole range of sort of issues that might be of interest to this group. That's everything from predatory lending to income inequality to private equity and money in politics and wealth extraction. And I want folks to also sort of stay tuned for some new standalone modules that we'll be pulling out. We're also going to be creating some new webinars, so exciting things happening in the Take on Wall Street world. And if at some point you'd like to host or participate in a training, track me down. takeonwallst.com. And find us. Now, to the issue at hand, though, thanks for that moderator privilege of talking about how important the work is of one of your host organizations. I want to turn to the truly impressive people on the panel here. So during the first part of the morning, you got a sense of some of the great alternatives that folks are working with to figure out how to combat Wall Street, right? How to look at alternatives to the big banks. And what we're going to do now is hear from the folks who are actually engaging in that work on the ground, so are putting these strategies to play on the local, state, and federal levels. So in the interest of time, I won't give you the bios of all of our amazing panelists. You should have handouts with them. And just to give you a flow of the next little bit of time, we're going to start off with each of our panelists making a 5-minute presentation. Then I'm going to ask some questions, and then, as with the last panel, we'll open the door and the floor to questions from the audience. So without further ado, I'm going to just run through everybody's names, and then we're going to start off with the second part of the California public banking work. So to my immediate right, we have Trinity Tran, who is the lead organizer for the California Public Banking Alliance. Next to her, we have Ali Issa, who is the coalition organizer with the New Economy Project. To Ali's right is Stephen DeMatteo with the American Postal Workers Union. And finally is Raul Carrillo, whose title is very long, so I need to read, who is the Demand Progress Education Fund Policy Council, who's with Demand Progress Education Fund and Policy Council, and an Americans Financial Reform Education Fund Fellow. So if we could have a round of applause to all these folks. And again, so I'm going to turn over now to Trinity Tran, who's going to tell us about, work us through.
Hello. There we go. Hi, everyone. I'm Trinity Tran with the California Public Banking Alliance. So it has been one incredibly exciting and groundbreaking year for the public banking movement, and this truly is the story of the underdog. This past year, a group of volunteer organizers with the California Public Banking Alliance took on Wall Street, and without any funding, we defeated the banking lobby by passing AB 857, the Public Banking Act, which Governor Gavin Newsom signed into law just a few months ago in October. And so the Public Banking Act paves the way for California cities, counties, and regions to form their own banks, accountable to the people, capable of providing a return that can be reinvested back into local communities and redirected to fund ethical and sustainable developments. As my colleague Dave Jetty touched on the more technical aspects of the campaign in the first panel, this brief presentation will focus on how we actually organized to accomplish this win. So we formed the California Public Banking Alliance over the year ago around the central goal of creating a pathway for local public banks. We formed a team of organizers and advocates from 10 cities in California, from Los Angeles to San Francisco to Oakland, all the way down to San Diego. We aggregated our organizing power and our resources to back a state bill that would streamline the process of creating the legal and regulatory framework for a network of municipal and regional public banks. It was the expansive reach of our coalition that was such a pivotal part of our win, because we were able to magnify and amplify call to actions and outreach to community organizations, to constituents and legislators across the state. Our strength was in our numbers. Altogether, we brought on nearly 200 national, statewide, regional, and community organizations to back this bill. To combat private interest, it was crucial that we assemble an alliance with a wide, diverse breadth of organizations representing a wide breadth of the public interest, from labor groups to elected officials to local governments to social justice groups and environmental groups. We focused on key stakeholders with huge memberships and huge constituencies across the state. This is a list of some of our major political endorsements. From 17 cities and counties passed resolutions to support the Public Banking Act, along with Democratic Central Committees that who regionally support the party from across California, including the biggest labor unions in the state. And it was our major endorsements from these politically influential groups that really helped not only build political capital behind the bill, but to legitimize public banking as an idea and move it further into the realm of respectable public policy. So within 7 months of our bill's introduction, we passed through 9 legislative hurdles, including 6 committee votes, 3 Senate and Assembly floor votes, with Wall Street opposing our efforts every step of the way. And to accomplish this win, we focused on 4 key aspects of organizing. One was engaging a wide political spectrum, from gaining the support of institutional left, including the California Democratic Party, to incorporating public banking onto progressive platforms, to coalition building and securing endorsements to increase the broad-based appeal of the bill. 3, we coordinated an inside-outside strategy, working with our legislative authors, guiding the bill from the inside, helping us negotiate amendments with committee chairs, and advocates working to target and pressure legislators to support the bill from the outside. And 4 was citizens lobbying. This part was super crucial to defeat the banks. We mobilized constituents and built a statewide network of citizens lobbyists to lobby both in district and at the state capitol to convince senators and assembly members to support the bill. So the Public Banking Act was an incredible grassroots feat, which we executed in just 9 months. And what we proved is that people power can triumph even against well-oiled corporate machines, because we had no funding, we had no paid lobbyists with minimal resources. It came down to being able to out-organize the opposition to translate public banking as an idea into a movement, into a political win. So now that public banking is legal, the fight pivots back to the city level as we work on implementation and coordinating the rollout of these public banks in various California cities, including LA, San Francisco, and County of Alameda, have already initiated and begun the process of formulating their business plan. So we are at an incredibly exciting moment in history, a historic moment to be able to fundamentally transform finance, to turn capital and credit into something that can help heal and rebuild and empower our communities rather than harm. Thank you.
Thank you, Trinity. And yes, please, I think there are some things we can't over-celebrate, right? This is a big deal. So let's give another round of applause before we go to all right, yeah, this is great. So the next person we're going to turn to is actually Steve DiMatteo, who's going to speak to us from the American Postal Workers Union. Is going to talk to us about a little more about postal banking. Steve.
Thanks, Erica. So Marissa Baradaran this morning, I think, gave us a really good overview of the concept of postal banking and where the ideas came from. And our work as a union started roughly around the same time Marissa, I think, dove into the issue. In 2014, the Postal Service's Inspector General, they have a little research unit, and they put out a white paper that started to look at the question of postal banking and whether or not it would be a good fit in the United States and what the implications of postal banking would be here. And that really started a flurry of activity in Washington, but around the country as well, and got a lot of people thinking about it and talking about postal banking in a way that we haven't for a long time in this country. As Marissa noted, it's not a new concept here. It's something we had and lived with and really benefited from 1911 to 1967. And it's something that came up in the public conversation at a really important time for the Postal Service as well, and Marissa alluded to this as well. Congress has put some lead boots on the Postal Service right around 2006, 2007 with the complicated pension post-retirement health benefit funding rule that nobody else faces. This has sort of made it a lot harder for the Postal Service to innovate and to find new products and services that it could offer well into the 21st century. And people started talking about postal banking as a solution that maybe the Postal Service could pursue to help shore up some of the finances while we were having this fight over this complicated health funding rule as well. So that was where the union's interest came into it, but it's also, for us, an extension of the work that our members do every day. We are really proud to represent people that are proudly dedicated to service. The Postal Service has for a long time fulfilled its mission to bind the nation together. And our members take that really seriously, and they're really keen to find new ways to contribute to social cohesion and to really create a better world for everyone. And we think the Postal Service, there's sort of some romantic and almost corny ways to talk about it, but it's really true that the Postal Service has done this for a long time. So we're proud to have put together another coalition in the Campaign for Postal Banking. I can have some handouts or direct you to the website later on. But we've got labor unions, consumer groups, financial reform advocates all working together to find a path forward for postal banking. Marissa noted earlier that there's a legislative approach. We could legislate action out of the Postal Service. We also see a path forward where we want the Postal Service to exercise the full authority they already have under the law. The Postal Service already does a lot of financial services. We do money orders. There's some limited remittance services that people already go through the post office. And we want postal management to use the authority they have to do some more of that stuff. So our immediate demands right now are let's put in ATMs in post offices, let's expand remittances both domestically and internationally. We can do that without a change in law. We can set up a system of bill payment and money transfer through reloadable, recreditable cards, the debit cards that Marisol alluded to. We think that's a way to bring lots of people into the system that are currently excluded. And we make no bones about it either that there's a real social need to address, certainly, and I think everybody's touched on that throughout the day. But we know that it would be good for our members as well. That gives us a greater stake to play in the Postal Service. It would bring in more revenue and help bolster the service as an institution, but also would be an opportunity for us to bargain for higher wages because we would be demonstrating higher skills and adding more value to people that would rely on these services. So we really think it's a win-win-win. Really the only losers in this situation would be the payday lenders and the check cashers, and to hell with them anyway. So let's go forward with that, and we're happy to be part of a big coalition fighting for the same thing.
Excellent. Thank you so much, Steve. So next we're going to turn to Ali, so to talk about public banking again, but this time on a municipal level. So Ali, you take it. Oh, sorry. No, yes.
Thank you so much, Erica, and Take Back Wall Street for the invitation. Happy to be here. As mentioned, my name is Ali Issa. I'm a coalition organizer with New Economy Project, which is an NYC-based economic justice organization that works with community groups to build an economy that works for all based on principles of democracy, cooperation, equity, racial justice, and ecological sustainability. Several years ago, New Economy Project, among other allies and partners, started discussing public banking in the context of New York. And in 2018, launched publicly Public Bank NYC, which it now coordinates. And Public Bank NYC at the moment is a broad-based coalition of over 30 organizations calling for the creation of a municipal public bank, which we said would make public money work for the public good. And members of that coalition presently include labor, including Communication Workers of America District 1, community orgs like New York Communities for Change, financial institutions and cooperatives such as Lower East Side People's Federal Credit Union, and groups focused on worker co-ops specifically, like green worker cooperatives in the Bronx. So as this membership indicates, public bank... Oh, that's okay. Oh, no problem. Slide, please. I was going to say, as this membership indicates, first and foremost, Public Bank NYC is a community organizing effort. What Trinity said really resonated with us because we believe that building grassroots political power is really an essential way to overcome what's going to be stiffer and stiffer Wall Street opposition and beyond. But further, it's also a way to eventually, once the bank is established, keep that bank accountable to those grassroots constituencies and the people that need it the most, people on the front lines of injustice in New York City. So that's why our outreach strategies prioritize frontline communities, immigrant communities, communities of color in New York, and specifically focus on groups that are excluded from that financial system and that are actually driving alternatives and creating community-led projects that the public bank will invest in. So we see public banking as part of a larger struggle for social justice and a way to transform New York City's economy. One way we forward that is through popular education materials, street theater, mock game shows, big fan of game shows. And one example of that is actually this one-pager, which we produced recently, that breaks down a little bit of how it works in a visually appealing way. Another little excerpt, if I could give you, is actually just the following presentation in condensed form, which we've found to be very effective when reaching out to community groups and community boards and beyond. So I would say, slide. This is part of the comic relief that is really effective in presentations. So New York City, right? There's almost 10 million people, taking revenue of over 90 billion a year, and this is where it goes. But before it's spent, it has to sit somewhere. And where does it sit? Slide. And the usual suspects of Wall Street banks. We're talking Citibank, Bank of America, and most of all, Chase. And these are the same private institutions which directly harm New York City communities. Slide. In the following ways. So first, they perpetuate inequality and poverty by redlining communities. We could talk about these maps later, but these demonstrate redlining and how a lack of bank branches in communities of color across New York open the door to check cashers that exploit communities of color and allow them to flourish. Slide. Another obvious one people are familiar with is climate change. Chase especially, but all the Wall Street banks heavily finance fossil fuels, endangering many New York communities as well as globally. Slide. And finally, evictions. Many of the banks that New York does business with back evictions very heavily, including the landlords which lead in numbers of evictions across the city. So clearly, slide, we have a lot of reasons to divest, but what about the investment potential of the public bank, which is in many ways the most thrilling and the galvanizing aspect of this campaign? Slide. And we break it down in the following 4 areas: workers' justice, financial justice, housing justice, and climate justice. Worker co-ops, community development credit unions, deeply affordable housing and mutual housing association models, and community-controlled energy. Slide. Sorry, I'm running through this. Brooklyn Cooperative Federal Credit Union is one such community development credit union that's a member of our coalition. There are 3 of the leading that are part of Public Bank NYC. And partnering with the public bank would allow co-ops such as this to expand their services in traditionally redline communities and grow that important challenge to Wall Street neglect. Slide. Another example is community land trusts. These are efforts to take land out of the speculative market, and we've heard time and again that such deeply affordable housing models require financing, so that would be a priority for the public bank. Slide. The list goes on. This is a community-controlled solar project in Sunset Park, Brooklyn, etc. So I just want to close by slide highlighting a recent action, wanting to make this engaging. We've organized our first NYC Worst Banks Awards past December. There's me in a tux trying to have fun and also list the ways that New York City banks harm communities in the city and beyond. Slide. And finally, coming up, which we could discuss further in a second, is rolling out a city council legislative package of bills, which would lay the foundation for a public bank in the coming month, as well as also beginning to work on the state level strategy, building on the excitement from the California victory to create that regulatory framework in New York State so that public good can flourish there as well. Thank you.
Excellent. Thank you, Ali, and thank you for your presentation and for your patience with my forgetting that Prezi doesn't work with PowerPoint projector remotes. Exactly. So Trinity and Steve and Ali talked about some of the amazing alternatives that are out there in the world that are being put into play. For our final panelist, Raul Carrillo, we're going to turn to some of the options that aren't so positive, things that fill the vacuum when we don't move forward with our own agendas to redirect how things should be, how the future we want to see.
Thank you very much, Erica. Can I get the clicker, or are we having issues? Okay, great, awesome. So as Erica mentioned, I'm not going to speak about a campaign so much as try to, in 5 minutes, introduce a sort of new whole dimension to this that I think it's very important for us to think about, not only in terms of what's filling the vacuum if public banking doesn't happen, but also considerations that we should take into account as we advocate for public banking. So I work with, again, AFR Ed Fund and the Demand Progress Education Fund around a variety of issues related to fintech. What is fintech? So financial technology has been around forever, right? Technology has evolved with finance and vice versa. If you take out coins and currency that you may or may not have in your pockets, you can see that they bear various engravings, signatures, barcodes, things like that. All of those tools were considered cutting-edge financial technology of their time, believe it or not, right? For security measures, those in particular. What we talk about today when we're talking about #fintech, or what goes under that moniker, is really corporate entry, non-bank corporate entry into the financial services space with the goal of automating, ostensibly, a lot of functions that are provided by the mainstream financial services sector, right? And that covers the whole gamut. But what I'm really focused on right here is the big tech companies and what they're doing in the space, right? So I think it's first of all important to realize that I think as people oriented towards thinking about finance, financial reform, financial regulation, we're always focused on the exploitative nature of the financial component, right? So what I'm saying today is that that's extremely important. I've spent my entire career fighting against that, as well as I imagine most other people in this room. But what these big tech companies are after is really, at the end of the day, the data, as well as the money, right? So the Bank for International Settlements put out a very helpful report in, I believe, August of last year, in which they talked about the business model of big tech. Essentially, it can be summarized as we need to get more users to engage in more activities, to produce more data, to get more users, to engage in more activities, to produce more data, et cetera, right? It's a big loop. So there's a natural interest in going into payments and into finance, more broadly speaking, because you get a lot more users into your ecosystem from which to harvest the data, right? You learn more intimate things about people, and you can monetize that in various ways. Obviously, you can do targeted ads like Facebook, Google, et cetera. This is also, these data stocks serve as the data that is used for credit scoring and other things like that. So you're building a surveillance system, and that's not necessarily the same kind of surveillance that like the NSA is doing, but you are building a surveillance system around the financial ecosystem. So let's talk really quickly about one, I think, particularly egregious idea. So Facebook has gathered a now dwindling consortium of corporate partners to create a nonprofit organization in Switzerland where they'll be hidden behind a series of legal shields from various regulators around the world. And what they want to do is get a blockchain, of course, and create a corporate currency which they will circulate within Facebook, WhatsApp, Instagram, but also all the various apps and payment systems of these other companies here, right? And what they're going to do is create their own medium of payment. And what you can do, ostensibly the promise, is that you can send money real time to anybody who has a digital wallet that is part of this ecosystem around the world, right? So in that sense, they're taking advantage of slow payments, inconvenient access, all the financial exclusion that we're talking about. They very much are filling a vacuum, right? The goal is to expand. It is almost an imperial in its objection, right? In its objective. The point is to get more and more and more and more users. There are a bunch of reasons why this is bad, involving systemic risk, our ability to manage monetary policy, a million other things. But again, what I'm focusing on here today is privacy, right? So the noble lie around a lot of these enterprises is that they're going to bring people into the financial system, right? But that means a very particular thing. That means bringing them into Facebook's financial system, right? That means bringing them into these other things that may be interoperable with the mainstream financial system, but are really their own sort of pockets within the global financial system, right? And something that I think is particularly important to note here that as financial justice advocates we maybe don't always do enough of is to say that financial inclusion means privacy protections. So some of you might recognize right up here on the slide the 2017 FDIC household survey. And when people are asked why they don't bank, first of all, it's because they don't have money, which is a problem that, for example, the Libra Project does not solve because you have to trade your fiat currency to get the tokens, right? But it's also mistrust of institutions and privacy concerns, right? So what we're talking about here is looking more like something like predatory inclusion, where people who are excluded from the mainstream financial system are asked to sacrifice their privacy in order to participate in this corporate ecosystem, right? And so public banking, I think, has an option here to regulate this space and stop some of these things even potentially from coming to fruition by not only providing access, convenience, speed, and solving some of the technical problems that occur within the system, but also creating a sense of privacy. And in fact, I would say that you are not going to defeat Facebook and all these other companies if you don't have a compelling response to how people are not going to be surveilled by a public banking system, by something that the government owns, right? I think that we have a tendency, people in this room, including myself, to not be so concerned about privacy, but many people in the United States, and particularly those folks who are excluded from the mainstream financial system, do have privacy concerns. They already interact with the government, with law enforcement, with welfare systems in ways that are invasive of their dignity. And so that has to be kept, I think, at the center of what we're talking about. So we have some tough questions as we push back against really these sort of spy networks that are being created in the vacuum that is left by financial exclusion. We need to ask ourselves, and some people are already doing this, when we push for public banking, what are the privacy implications? What are the surveillance implications? Who's going to have access to this data? Are debt collectors going to be able to easily access accounts and come in after people and enforce judgments? Right now, most of those protections are determined at the state level, even though the Treasury has a few rules, but that's something that state municipal efforts have to consider. To the extent that small credit is involved, underwriting, scoring, what is the federal government doing in that sense if it goes through the post office? Very important. Keeping data between institutions. So the Federal Privacy Act of 1974 and rules promulgated under it prohibit certain institutions from sharing information. So for example, the Postal Service can only collect certain data and it can't send it to the IRS. But we also know that, especially Demand Progress, I would say, knows from its experience with FISA courts and fighting the Patriot Act, et cetera, the government agencies don't always keep their promises, right? So that brings up the question of, can technology actually be pro-privacy? Are there things that we can do at the design level that prohibit mass surveillance from happening, or at least mitigate it? That includes things like questions like, do we add a complementary layer of digital cash to the digital account network with Fed accounts, right, in order to protect privacy and to maintain some of the civil liberties that we have via the cash system? Now, there's a long list of questions, but basically my point here is that we can't be thinking about financial inclusion and exclusion without also thinking about the privacy implications, and this is also extremely important for coalition building. I think hopefully we can get into that as we go along.
Excellent, thank you. And thank you again to all of our panelists. So we're going to dive a little deeper into some questions now before opening up to you in the audience. And we'd like to start with Trinity. So since this is a panel of organizers or campaigners, and David Jetty on the last panel referenced a little bit of the evolution of the California work coming from divestment struggles, right?
Yeah.
But I'd love if you could tell us a little more about the local work, how you moved from sort of LA to statewide.
This is our third fight against Wall Street in 3 years, our third grassroots fight. And started in 2017. A lot of our organizers were viscerally moved by what was happening at Standing Rock with Indigenous groups fighting to prevent oil pipelines from encroaching on Indigenous and sacred lands. So we in Los Angeles decided to shift the front lines from Standing Rock to Los Angeles. Wells Fargo was one of the financiers of the Dakota Access Pipeline and the bank that our city primarily banked with. And so by virtue of our tax dollars being banked with Wells Fargo, we were essentially complicit to these crimes against humanity and the earth. So we delivered a hard-hitting campaign within 9 months through legislative advocacy, citizens lobbying, coalition building. We pressured the city of Los Angeles within 3 months to divest about 40 million in holdings from Wells Fargo. 6 months after that, we got LA City Council to unanimously vote to disqualify Wells Fargo Bank from the city's commercial banking services because of their substandard Community Reinvestment Act rating. So coming off of that win, that was again done with no money. That was just purely grassroots people power. We leveraged the win against Wells Fargo because we realized that Los Angeles didn't have a socially and environmentally responsible option. If they were going to move that money, divest that money, it would have gone to another extractive, predatory Wall Street bank. So our only real alternative was to create a people's bank accountable to the people of Los Angeles. So we leveraged the win from Wells Fargo to create Public Bank Los Angeles. Just in less than a year of us launching that campaign, Los Angeles City Council President Herb Wesson put Measure B on the ballot, which would have changed one section of the city charter to allow the city to explore the options for a public bank. Again, grassroots, unfunded. We had 4 months to organize on that campaign with about less than a tenth of the budget of a typical ballot measure in Los Angeles. And within 4 months, we didn't win the campaign, but we got 44% of the votes and 430,000 people to vote yes for at the time, a relatively obscure and new idea. And considering that most ballot measures that challenge corporate interests get buried by a 3-to-1 margins, 44% and 430,000 people was pretty damn impressive. So we leveraged that win again, and then within 4 months, we introduced a state bill. So this time around, it wasn't just LA versus Wall Street. We built an alliance of 10 cities, and it was California, the 5th largest economy in the world, versus Wall Street. So instead of organizers working individually from the different cities trying to create their own legislation, it made sense for us to back one state bill that would just streamline the process. And that's how it all began. So it actually is just, it's funny because I always refer to it as a bare knuckle street fight between Main Street and Wall Street.
Thank you. And I'm not sure how many organizers there are in the room, but this is not normal, okay? So, so as much as we want to celebrate, the effort and deserve to be celebrated, don't think of this as the timeline that you should expect to see across the country. All right, this is exceptional and super impressive. But speaking of public banking across the nation, turn to you next, Ali, and ask about what. So you're looking in California. You use the municipal model, sort of like multiple cities, to build a statewide campaign. Here in New York, which is just a city, but it is the largest city in the country by substantially. What differences do you see between the campaign that you're gearing up to run and sort of moving into, and sort of a statewide effort, and what do you think you might be able to draw from what you know about Trinity's work in California?
Yeah, sure. I think there's a lot to draw from, and there are some important differences. I think, first of all, what really resonated actually was the story about Wells Fargo, because you noticed, I threw up on the screen there, those were the list of what they call the designated banks. So the banks that are allowed to do business with the city, and I mentioned how the Wall Street banks dominate. They take the lion's share of the deposits. Wells Fargo is actually what they call conditionally designated, because similarly, it was knocked off the list. So they promise that in a couple years it'll no longer be eligible to take deposits. So there's clearly across the country, and especially I think in the coasts, channeling of the divestment energy and a desire to pull money out, basically defund these industries which are harming people and the planet, from prisons to the climate to weapons and beyond. So that animating energy of the divest invest, I think, is very similar, and it's drawing on similar movement sources, which is also, I think, what I'm hearing from the coalitional efforts in California, is that this is such a cross-movement issue that it really can galvanize people working on housing, working on financial justice issues, working on many issues, so that it's not so much that groups drop what they're doing, right? Because people fighting homelessness, they got some immediate concerns. It's more that groups that are working on particular issues see public banking as a vehicle to further achieve that, to deepen it, to broaden it, and that people, like mentioned in the previous panel, see financial justice, the monetary system, municipal finance, as something that can be democratized and infused in all social justice struggles and can actually expand them, which is also, I think, an element of what's somewhat unique in New York City, which is a really rich landscape, an environment for some of these community-led institutions and alternatives. I mentioned community land trusts. At the moment, there's actually, in various stages of development, 12 across the city, and that's considering, New York's geographical limitations is stunning. There had only been one for many years, then two, and now there's this explosion. So it's really, I think, in our case, keying and finding the leadership in the grounding in those community-led initiatives, the community development credit unions you mentioned, as well as this growing, burgeoning effort to have community-controlled alternative energy. And then I think finally, an important exchange and lesson we can have is, I think what we're hoping maybe talk about later today, is how we can take it, starting in conversations like this, but even further popularize this notion, so that's not just activists, it's not just organizers, but it's people generally that are able to be galvanized around a vote to help then shape the public bank. When we talk about governance, and I know many of the California groups have mentioned that, how do we build a system that's truly fixing those values that we set out from the beginning, so then when we have a public bank in a year or 2 or 3, it's really going to execute those values and put the frontline communities at the center? And how can we draw from governance models that we're creating on the fly and that are around the world as a model to make that happen. So I'll stop there.
Excellent, thank you. So I appreciate on the last panel how much Marissa and David and everyone talked about the complementarity of postal banking and public banking, right? So we have public banking here, whether it's municipal across states in a single location. It's for government entities, right? But postal banking is for us regular individuals. So Steve, I'd love for you to talk a little bit more about why the Postal Service is well positioned to do this type of work beyond the fact that you did it until 1967, although to a limited degree.
Who has a passport? Right? Where'd you go to get your passport? To the post office, right? You didn't go to the State Department. There's not an outpost of the State Department in every little town, but there is a post office in every little town, right? That's sort of the biggest feather in our cap, we'd argue, is that we're everywhere. There's 35,000 post offices across the country. That's more than McDonald's chains and Starbucks put together. It's really a question of ubiquity, and it's not just about scope, but really the locations where postal facilities are is important too, because there is a higher proportion of post offices in these small and rural areas than there are other outlets, and we think that's both politically impactful but socioeconomically important as well when we sort of map out where post offices are located relative to where bank branches used to be but aren't anymore. There's a statistic, I might get it a little bit wrong, so I'll look at my notes, but of the 35,000 or so post offices, I think 60% of them are in zip codes where there's only one bank branch, one or zero bank branches. So we know that the sort of nationwide network of the post office touches people in a way that the commercial banking system doesn't. That's one important aspect of our argument. Another one is the fact that the public really trusts and really likes the post office. There was a thing that came out a couple weeks ago. I think it was Morning Consult. The Postal Service has favorability ratings in the high 80s to 90%, consistently rated the #1 most trusted federal agency. People interact with postal workers, their letter carrier, the clerk at the post office on a regular basis. They're trusted parts of their community. People know their names. People know who their postmaster is in rural America. Postal workers really are at the center of so many communities, and we think that's an important attribute as to why we can contribute to that as well. The passport issue, I think, extends, that sort of thing I led off with extends to other areas as well. The Postal Service has well-established relationships with other parts of the federal government, and that's one of our arguments, both from a regulatory side but also politically and legally. The Postal Service has an expansive ability under the law to partner with other federal agencies, and that's something we're encouraging them to explore now. So when the Fed announced the FedNow payment platform that they're developing, we had some friends reach out directly to the Fed and say, hey, don't forget about the little post office when you're putting this together. And so we're really pleased that the Postal Service keeps sort of perking up in people's visions. We want to do the work. Our members want to do the work. We want to be able to serve our communities and serve our neighbors as well as we can. So we are broadly open to as many different visions and views of how postal workers and the Postal Service could be part of this better, brighter future.
Excellent, thanks. And Steve, I imagine you saw this. So, not only is the Postal Service by and far the most widely trusted agency in the government, it is, according to a study a couple weeks ago, more trusted than Tom Hanks and Oprah Winfrey. So,
take it.
Just to show you, so you should be on good standing. So, Raul, I don't want to belabor or sort of overemphasize Facebook labor because it's just an example of many sort of types of things that could go wrong. But I'd love if you could address the problem that it was allegedly designed to fix and what better alternatives there might be out there, what ways that those of us on our side might be able to address their alleged issues.
Great, thanks, Erica. So I would say that the Facebook Libra project is intended to solve whatever problem you happen to have with financial services, right? At first, it was marketed as banking the unbanked, And then Representative Ayanna Presley and other folks got up in front of David Marcus last July. That's the head of Calibra, the digital wallet system that Facebook operates within the Libra ecosystem. And she brought up a bunch of concerns about, this isn't actually banking. This is maybe a deposit substitute in a mobile wallet that should be regulated like a banking system, but this isn't banking, right? No one gets an account from the Libra project, right? They get a digital wallet with significantly fewer insurance and security protections, right? And so that was the original purpose. And then now it's about cross-border payments, right? It's about the ease with which people send remittances, et cetera, et cetera. I think there are problems with cross-border payments. We've talked about a lot of them today. They were brought up on the first panel as well. There are problems with the ability of people to send money to each other quickly and securely. But we already have technologies, I think, that are being used by the public that help with this. Obviously, FedNow, or Fed 2024, is an idea. The post office uses the Dinero Seguro program, which is not real-time payments, but you can send, international money orders to people relatively quickly and securely through the Postal Service right now. There are all these public things, so to speak, that need to be used and need to be funded properly. And there's no reason that Mark Zuckerberg should get to put on an American flag cape and run around and say, we're going to beat China, we're going to develop this technology on behalf of the United States, when the association is headquartered in Switzerland, it's not reachable by regulators, et cetera, et cetera. And so I think that there are a lot of promises that we have here, right? I do think that it's important to integrate, again, the privacy perspective into all of this, because that is how you pull people into the system, it's how you defend civil liberties, and that's how you ultimately beat these people that are pressing up against us.
Excellent, thank you. And speaking of the enemy, or trying to beat folks, Trinity. So you had these 3 campaigns, consecutive campaigns, and as you mentioned, you went up against Wall Street, which obviously is well resourced. Can you tell us some about what the opposition was like, and what their messaging was like, and what your counter messaging was like?
Yes, the Public Banking Act was opposed by the California Bankers Association. Altogether, 9 financial lobby firms lobbied against us as we were moving through the legislature. They made a real concerted effort to prevent credit unions and community banks from supporting the bill. They released op-eds against us. They pulled senators and assembly members off the floor to try to flip our votes. And they tried to do a lot of fear-mongering based on conflicts of interest, insolvency. We were able to overcome our opposition by mobilizing constituents to lobby senators and assembly members in district, being able to, and at the state capitol, being able to assuage a lot of their concerns. Public banking, even though it's been around for 100 years with Bank of North Dakota, and around, globally, 40% of banks are globally owned, but for all intents and purposes, this was a new idea that we were introducing into the California State Legislature in 2019, which meant we had to do a lot of education efforts with legislators. So it really came down to face-to-face conversations, educating legislators about the common harms of the banking industry, and how public banking is a real and viable alternative. Lobbying both in district, lobbying at the Capitol, and then also the inside-outside strategy with our lead authors was a crucial part of being able to combat Wall Street opposition, because they were able to talk to members directly to combat some of the opposition points. And we also worked with our legislators to negotiate amendments within committees, because committee chairs are typically very impervious to lobbying and public pressure. So it's crucial to establish working relationships and diplomatic relationships with legislative authors so that you can work together to strategize moving through all of those legislative hurdles, which for us was 9 altogether before it landed on Governor Newsom's desk.
Thank you. Ali, so even though your campaign is much more in sort of in the nascent, well, not nascent, but sort of a much earlier stage, I'd like, if you would, to take a brief thought experiment and fast forward to that glorious day in the not so distant future, probably not a year, but probably not 4 months, but the not so distant future, when you've won. right? So when public banking is a real thing in New York City, what kind of how do you think that will manifest across the city?
Yeah, it's an excellent question, and I think it's a part of the reason why I think we've been so deliberate in trying to imagine what the priorities of the bank will be, who will be making those decisions, and getting really precise in the kinds of loans that are going to facilitate deeply affordable housing and the other priorities. But I think another experience that comes to mind that I want to bring in, I was very fortunate to be able to, for separate reasons, visit Berlin about a little over a year ago. And I got to visit actually one of the Berlin public banks, Sparkasse, I believe it's pronounced. And just talk to one of the officers there whose job it was, in fact, to train union leaders and other community people to sit on like an influential advisory board of the Berlin Public Bank. So that was, I think, an important model of governance that people in California have discussed and elsewhere that I think is essential to our vision of keeping the public bank democratic and accountable, and then making those investments, right? We want to see a particular kind of continuing flourishing of community-led projects. We want to be able to, address head-on the housing crisis of New York City like so many other places. We want to be able to divest from the fossil fuel industry, at least symbolically at first, by pointing out that the city, through its banking, is invested in that. And I think ultimately want to also make it part of the popular culture. And part of what we have done is like series of community meetings across the 5 boroughs. So when you take it to community organizations, people are, saying, tell me more. Then they say like, okay, that's a great idea. I'm so excited. And also try to then imagine, what that means for any struggles they're going through as an organization, as individuals, where they see that Signature Bank, which is a bank that is local and New York banks with, is financing their landlord that has evicted them, right? So it gets this root level approach of thinking about social problems where Band-Aids are not going to help and you have to address kind of as a whole. And the financial system is always going to be a major factor there and help in a broader political and economic transformation that we obviously so desperately need.
Excellent, thank you. Yeah. On that note, looking at sort of these big, broad systemic changes, as Alexis referred to in the last panel, sort of these moonshot goals, postal banking, despite it having been something we've already had, still is, it's a big shift potentially, and as was mentioned on the last panel, there are approaches of going through Congress to make it happen, executive order to make it happen. But what do you see just as the threats facing the campaign, Steve, as you're sort of moving forward to make this happen beyond the obvious of a Congress that's not particularly interested in it right now?
So one of the biggest threats facing the campaign, and credit to Marissa for identifying this early on, is real threats to the future viability of the Postal Service. So there's this complicated thing that I mentioned about future retiree health benefit pre-funding, where the Postal Service was forced to put away $6 billion a year over a 10-year period. And that, for a benefit that everybody else just pays as they go when those bills come due. That really hamstrung the Postal Service and stopped them from being more innovative and being able to invest in the types of products and services that they should have been doing over the last 15 years or so. So that needs to be resolved, and thankfully in just a couple weeks there's a bill that's going to go up on the consensus calendar and pass through the House, and we need the Senate to adopt their end of the bill and get it to the President's desk. And if I'm being honest, I think we still have some work to do on the Senate side, but hopefully that could spell the Postal Service some real relief in the near term. Medium term, we're going to have a fight over privatization. The current administration has made it very clear that they have a target on the back of the Postal Service, and depending on how things go in the next year and a half, we think that fight could very much ramp up. But we do think that there is nonetheless a path forward for some of this stuff. I've said it a few times. The Postal Service has more authority than they're currently exercising. Raul talked about Dinero Seguro, the transfer system to, I think, 12 Latin American countries that the USPS currently does. The one thing that just in this whole debate confounds me more than anything else is the Postal Service. So we mercifully didn't leave the Universal Postal Union, which is this UN agency that connects post offices all around the world. Trump was trying to kick us out last year, but we stayed in. The UPU runs a program called the IFS that connects pretty much every post office around the world, like 250,000 post offices around the world, and allows people to transfer money post office to post office wherever they are. The United States Postal Service could take part in that system right now. The POS system, like the cash register system that postal clerks use to ring up your stamps today, has that software on the system. It's literally just a matter of the Postmaster General saying, yes, let's flick this switch and connect postal customers in the United States to billions of people around the world, and they haven't done it. So there's a block somewhere in terms of their creative thinking, in terms of the political risk that they're willing to take. This is something with a big, broad movement of people demanding this type of change. We could get turned on tomorrow. So that's why the work of coalition building is so important and taking part in spaces like this.
Excellent, thank you. Raul, I was wondering if you could talk for a moment about some of the key privacy issues that public banking advocates should grapple with given the advances in technology. As in the last panel, Alexis mentioned, like, ooh, biometrics, that's a little scary to me as well. So, what should we be paying attention to?
Sure. So I will also go on the record as personally saying that I'm not interested in tiered KYC that involves biometrics, that sort of thing, because government surveillance of certain populations is not theoretical. It's happening right now. I don't mean to be a doomsdayer, but this is just like reality, right? I had a privacy law professor, Eben Moglin, who used to open the first lecture of his privacy law class by saying, most of my family was taken in the Holocaust, but next time they're going to get every single person, right? Because they're going to know where everybody is, because of credit cards, because of payments, etc., right? And today, so I'm from the US-Mexico border, right? There are concentration camps outside of where my grandparents live. And there are people who are United States citizens who don't have the appropriate birth certificates because they live in rural areas or whatever, who are even being taken into those concentration camps. So this is very real, and it's especially important for certain people. There's a color to surveillance, so to speak, right? And so I think when we're getting to the level of talking about adjusting, KYC and using new technology and sort of things to bring people into the financial system, we have to be extremely, extremely careful and ask if it is worth it. And this is, it really goes back at the end of the day to a point that Mersa made in the first panel during the Q&A, which is that we should not be treating access to credit as the structural solution to all these problems, right? Small dollar credit naturally comes with surveillance. Anytime you're dealing with money and poor people, it comes with watching them. That is the idea in the United States of America, that poor people must be monitored, they must be watched, especially if they look a certain way, right? So when you're doing cash transfers through welfare programs to poor folks, they get spied on. Virginia Eubanks covers that very well in a book called Automating Inequality. But it's even more so when we're talking about using underwriting and credit scoring for small dollar loans, right? So considerations need to be taken into account. This is actually an area where I think technology can be helpful. So several weeks ago, there was a hearing in the House Financial Services Committee on banking on your data, and a computer scientist named Sini Kamara, in a way that I can't do justice to, listed a bunch of technologies that are helpful for using encrypted data for credit scoring to the extent we want to go down that road. There are technologies available to be helpful there at the payments layer, at the loan level, right? And the idea with this is especially important because the idea with all these fintechs is that not that they're just going to help with payments, but that eventually, and this is the stated goal of, for example, the Libra project, they're going to have loans involved. They're going to have derivatives involved. Like there's going to be a whole financial system, right, through which other forms of surveillance could take part. So it's important to consider, what comes along with the access to credit narrative and what we're saying about surveillance when we talk about that. Then on the payments level, I think, and I say this respectfully as a contribution, that a lot of people are going to have issues with the Federal Reserve System having a sort of God view over a centralized ledger, or having the potential to do that, right? And that's not necessarily just because of Ron Paul reasons, right? As stated previously. So there is an option, I think, to replicate the existing system in the sense that you have relatively private, anonymous transactions in the form of digital cash, in addition to the bank accounts, to the Fed accounts for all, to the accounts that may exist within USPS. And there are folks from the International Telecommunications Union working on that. There are folks at Stanford working on that. There's a private industry group called eCurrency Mint working on that. Like, this technology is available. There's this tendency, I think, when we talk about all this, to be wowed by the technology that is presented by the fintech industry groups, when there's actually a lot of pro-privacy or anti-surveillance technology that is out there. And if you want to talk to technologists about how to build these systems, why not aren't you talking to the people who care about privacy, as to the people who don't, the people who are invested in getting the data as well as your money?
Excellent, thank you. And at this point, I'll stop being selfish and turn to the audience and allow folks to ask any questions that you have. We'll start here with the person in the blue shirt, and we'll move to the left.
Thank you. Thank you so much to the panelists. I have just two really quick questions. The first one for Trinity. From an organizing standpoint, having gone through the three campaigns, is the legislative route as opposed to the referendum route preferable from your perspective? Or which offers more opportunity for opposition influence? And yeah, which one would you prefer to go through if you had to do it again? And then for maybe Ali and Raul, maybe if you can just talk a little bit about New York City's new digital currency and payments platform that they've announced. I've heard it referred to as a digital public bank, but I don't know too much about it.
Absolutely the legislative route. And we learned that through Measure B. In Los Angeles, we would have had to, without funding, with the grassroots budget, we had to message to 1 million voters versus 120 legislators within the California state legislature. We had a Democratic supermajority, so out of those 120, it came down to about 90 legislators that we had to lobby versus trying to communicate to 1 million voters. You know, with Measure B, the banking lobby got the LA Times to release an op-ed that was timed to drop right before the absentee ballots dropped. So that decimated our early votes. Grassroots campaigns will never have the ability to combat the potentially unlimited funds that the banking lobby could push forward in a referendum. So definitely the legislative route. It's a lot easier to be able to have constituents reach out and influence the vote of legislators as opposed to doing a ballot measure.
Could we mind just repeating the question from the front of the audience? Sorry, the second question in the comment.
Payments platform system, and I've heard some people refer to it as a digital public bank. I don't know if you know anything more about it. If not, no problem at all.
Sure. So I think what you're referring to is the inclusive value ledger that Assemblymember Ron Kim is supporting, and other folks in New York. I'm not going to give an organizational comment. I would just say that it seems very attractive to me in the same way that all these public banking proposals are. Again, people have raised privacy concerns about that despite the ostensibly decentralized nature, right? And this is particularly important in New York because there are a lot of undocumented folks. There are a lot of people who are under the watch of government agencies for not all the best reasons. And we've seen how that flight pays out with the attempt to make the IDNYC cards into smart chips, right? So someone referenced these cards earlier as being acceptable identity to get into banks, right? Well, now what they're trying to do in New York City Council, or some folks within the mayoral administration are trying to do, is put smart chips on these cards that allows you to do financial transaction and allows MasterCard to take fees and all these sorts of things, right? And so all of these technologies, again, unless they're designed in a certain way, have the potential to be abused, and that's something really important to consider, I think, in the midst of all the great benefits that public banking options and public banking-esque options create.
Yeah, I would say Public Bank NYC is still looking into this Ron Kim proposal, but doesn't have a position quite yet.
Hi. My question is for Raul. I was the guy that mentioned biometrics earlier, and you're talking about technology and privacy and how public banking could erode these privacy concerns in order to make up for the gap in information and creditworthiness of some of these folks that might need it. Obviously, banks are a repository for information on account balances, but also credit information, economic activity. And the point at which this money is made and distributed to the economy, we're talking about changing the control over that. Obviously, the most private form of money is probably just paper cash. So I wonder, Raul, how you look at paper cash in a structure where the unbanked can have more access to banks, and what place paper has in it, and then also what place some of these technologies have and which technologies you are looking at. You mentioned a couple from some academics that you've talked to. Obviously, you mentioned Libra and disdainfully mentioned their blockchain, which, for anyone who doesn't know, is this decentralized ledger technology. These are systems that decentralize access to ledgers, a lot of times through encryption and cryptographic methods. Do you think that they have a place in providing digital cash? Do you think that blockchains or encryption technologies can be married with things like biometrics to get a central authority out of the bookkeeping system, but allow code to do it? And how useful is that compared to just having paper cash?
Great. So we could definitely go on all day talking about the merits or demerits of blockchain. I will just first of all clarify that I don't have it out for blockchain. I don't think anybody I work with does, But blockchain is also not truly decentralized in most cases, to my understanding, right? The node validators still have the potential to decrypt data that they put in. There are still options for security hacks. There are all kinds of things that concentrate power within the system, right? There is the possibility of distributed ledger technology or other technology definitely helping out with pro-privacy replication of cash or something like that. So for example, the e-currency mint proposal at the user level functions almost like a, so in China, where this technology is all way further advanced than it is in the United States. Essentially, you can take your phone, which has like a QR code, and tap it against somebody else's phone. Now, the security protocol is within the QR codes, is within the phones, right? So it's not reporting to a centralized node in the system. What it's doing is it's saying, I'm a Fed account wallet. I'm a Fed account wallet. I have this much. I have this much. Okay, now you have that much. Cool, we net out. There's no counterfeiting. There's no double spending, et cetera. So there are those technologies that can help, and I very much personally see those as being helpful. But what I think the problem is, the space is now polluted with these corporate efforts that we're talking about, right? Libra Project arguably doesn't need a blockchain, but they want to use it to get street cred, right? To seem cool, to seem like they're fighting the man, but they are the man. Mark Zuckerberg is the man, right? So, and that's why a lot of cryptocurrency and blockchain people are actually mad at Facebook, right? Extremely upset. But I do think there's a place for all this discussion to be happening. I'm happy that some of it's happening right now, and excited for it to continue.
Thanks, Raul. Amazingly, we are at time unless somebody has a very, very, very quick question for one person. Yes, otherwise, then I'm going to call it, we're at time, and we're going to turn it, so again, we could give a round of applause to Trinity, Ali, Steve, and Raul. Really appreciate their sharing their experiences and their campaign work. I'm going to ask, Porter's going to come up now and just close us out, and then we'll call it a day.
That was awesome and inspiring. I hope you guys had a good time. I just wanted to thank you for coming out today. Please make sure that you registered for the event or signed in out there so we can continue the conversation. I want to thank all the panelists and all the moderators for their work and for the inspiration they gave us today. A special thanks to the AFR team, Calvin, Jonathan Diop, Linda, Monica, everybody I am forgetting, and to Lisa Donner, whose idea this event was originally, and to Erica and Manla on the Take on Wall Street team. And Manla specifically, who chased easels all over town last night, who ran out of printer ink and still totally owned this event in all senses of the word. So he's back there. Give him a big hand of applause. Thanks, you guys.